Hey everybody, this is Paul doing a quick dividend video here. Um, just kind of want to go over the market, like where the portfolio's at right now, that kind of stuff. I'm doing this about a day or so early. As you can see, I have a big message on my E-Trade account here that says that this whole thing is going to shift over to Morgan Stanley here pretty soon. So, I have no clue what that view is going to look like. Um, I have no clue anything about what the account's going to look like. I'll figure out what it looks like after the 4th, I guess, when I get access back to my account, because they decided to do this over a long weekend, I guess. So, sometime in here I'll be able to log into my account at 4 o'clock for some reason. But whatever. So, I'll be able to check my account, see what everything's doing. I do have dividends that are going to pay out normally that would pay out on the 31st. That pay out on the 31st, but are going to pay out on the 1st, but I'm not sure how that's going to work, but we shall see. So, this is currently the portfolio as it stands. As you can see, currently got a little update going on. It's the middle of the day right now. Market is currently doing what the market does. So I guess let's go over some data here. And then, like I said, by the time I have this next video, all this might look a little different. So as it stands right now, I did actually hit one big, or goal, I guess if you want to call it that. So this number right here, because I don't include the dividends from my other things in here, but this portfolio by itself is effectively generating $2 an hour if you have it on a 40-hour work week. So there's the math that makes these two work. If you want to pause or whatever. But it just goes by how many seconds, how many minutes, how many hours, how many days are in a year kind of thing. And you can just figure out your monthly, you can figure out break it down, and then to figure out your weekly or your bi-weekly, what it would be for a 40-hour work week. You know, there's that right there. So you just take, once you get this number, actually once you get this number, I believe, and then you can break it out like that. So this is something you actually might want to do if you're trying to figure out, okay, here's how much I make working right now. Here's how much I need to make if I want to retire and, still have that same amount of income coming in. So that's a little general thing right there. This doesn't include taxes, obviously, but you can get the general idea. So as it stands right now, per my last video, as I said, I've been adding money to SPHT and AFB. And then, just basically been adding money. I do have different things going on with my dad. I had like a bunch of dental stuff go on. Plus, I have the blower on my AC went out because on the literal hottest day of the year in Louisiana. So that's real fun. So I guess let's go over the economy. Why is the market all of a sudden happy when it was selling off for a straight week there, and then everybody was talking about going down to 4,200 on SPY? So if we take it out to the 1 month, you can kind of see. So I did my last video right around here, and then the market proceeded to kind of trade in this little range, and now all of a sudden we're jumping. So what was going on? Well, the Fed was talking about possibly doing more hikes, so the data was coming in strong. But now, towards the end of the month, there's other data coming in showing that the job market might actually have some softness to it. So the big thing is that they're trying to reduce the number of job openings without increasing the unemployment rate. That's their magical soft landing thing that they think they can achieve. They're kind of achieving it at the moment, even though nobody believed them. Nobody still believes them. I still don't believe them that it's possible, but we'll see. So the job numbers, the openings came in much dramatically lower. And as you can see, the market reacted in a very big way to that. So pretty much job openings came in almost 800,000 lower than what they were expecting, and this is what you get. You get a massive rally in one day, reversing all of this. This is called fill in the gap right here. It's if we had broken lower, we were going to break lower in a very big way. But because the numbers came in lower, and that's a very big indicator that the Federal Reserve watches to know if they want to pause, because that's what all this is about, pausing the rates increases. So this was above 2%. This was above 5%. This was headed to 4.5%, which this is the one that Wall Street actually cares about, because companies like to finance their debt as far out as possible. So this is the one that they really care about. Like all of this came down, and you can see the market flat out reacting to that, and especially the Nasdaq. So, and then this morning, the ADP number that nobody cares about. ADP is just a general. It's literally just a random number generator. I would not put any stock in this. They are constantly wrong, but the market's taking it serious today because it kind of lines up with the JOLTs thing. That job openings are down. Maybe ADP is saying that the August numbers might be weaker. The problem is next week we will get. I don't think we don't get it on the first, but we should. I don't think we'll get our job report on the first, but it'll be the 8th. But when we get the job report, if it comes in higher than this, then the market's going to have a reason to sell off, and then you'll see rates go higher. If it comes in much, much higher than that, then this will go back up above 5%. The market will sell off, and then September can be kind of nasty. September is a very nasty month for stocks, anyways. So that's not good. So why hasn't the U.S. economy, kind of collapsed right now? And it always basically comes back to this chart. So this is the chart that's driving the U.S. economy right now. So while renters are being squeezed from multiple sides, be it their rent increasing or their car payments increasing, because cars are still adjusting to the higher rates, people in mortgages, as you can see, are locked into extremely low rates. And being locked in means that you don't want to move now, because why would you want to take your whatever right here, 3 point something percent, and exchange it for at 8% or whatever they got, or 7% now that they have. So these people are stuck in place. They have nothing better to do than save their money and wait for rates to come down. And that's exactly what people are doing. So the U.S. economy is pretty much running off of these guys right now. Also, the housing market should be dead at the moment with these rates. It should be completely dead, but it's not. And the reason why is, as you can see right here, this is from home builders. What's the easiest, most effective way to get buyers off the sidelines? And as you can see, mortgage rate buydowns. So what this means is this is a trick from the 80s, back when boomers used to talk about their high interest rates. This is a trick that mortgage companies do and builders do to say there's a way that they kind of do this, and it's very weird. I'm not even sure how they do it. I don't know the exact science behind it, but this is just a chart you can use. But it's called mortgage rate buydowns. I wish I could explain more about it, but there are people that are far more knowledgeable about that you can look up that can look that up for you. But basically, instead of getting in at a 7% rate, it gets you in at, like, say, a 5% rate. So it's something that mortgage companies are doing. It's something that builders are doing, and that's why new builds are selling. So housing has completely, effectively halted. Building is still very hot, and building is like construction employment. So that's just kind of what's going on. Um, it's kind of a very interesting thing, and then also this is kind of an interesting thing. Thought it was kind of funny when the market was freaking out about the 10-year going up, because this is all the companies that were issuing debt on the 10-year. And there's only one or two companies that were actually issuing 10-year debt at, like, say, 7% or whatever like that. So you can see a lot of them are at 5%. This is not going to break these companies. And then also, this is just literally the most major chart that's driving this entire market right now. Why we haven't had like some like huge recession immediately. During COVID, this is what companies did. All like there people are talking about this debt maturity wall. It's a blip on the radar. 6% of the companies in the S&P next year have to refinance their debt. This year it was only 2%. It goes up gradually, but this is not enough to tank the market. So rates matter for this 6% of companies, and rates matter for this 8% of companies, but what the market really cares about when it comes to rates is buybacks and debt finance buybacks. Companies that can issue billions of dollars in debt to buy back their stock. That's one thing that the market is very focused on. And also the reason why higher for longer hurts the market, as you can see, it does start to add up. If we keep these high rates for this many years, this is not going to happen, by the way. But if we start to get into this, and we start to get into this, and then we start to get into this, how do these companies offset these higher rates? Because these rates right now are almost double or triple what they refinanced at the last time around. But this is the big wall right here. If rates are somehow this high at 2030, I don't know what to tell you right here. That's a problem. So that's just one thing to watch. And then we have yeah, and this is just right here. 80% of corporate debt is long-term fixed versus just 58%. So this is another reason we're just not having a recession right now. If this if these two charts look the same, companies would have to cut, especially this floating rate. That means that it would adjust as the rates change. Companies would have to lay people off because as the rates go up, their cost to service their debt would go up, so they would have to lay people off. So that's why it was so easy for companies. That's why companies were almost forced to lay people off, is because they had a lot of this floating rate debt. So as the Fed was raising rates in the 2005 to 2007 area, and the 2000 up to 2008, cost to service your debt was going higher. That's just not the case now. And this is also a very, very similar chart to what's going on with homeowners right now. Nobody's using floating debt anymore. And our debt is on 10 years. Homeowners debt is on 30 years. In the EU and UK, they do I think it's 5-year contracts, which is crazy to me. So when they change their rates, people start feeling that immediately. And that's why their economies are going in the tank right now. Um, so that's definitely a big thing. And then this just shows the 10-year, why everybody's freaking out about it. So this just shows 10-year bond for the U.S. Treasury. As you can see, it goes back to 2008, and this is the highest it's been. But the way that the debt is set up is just so different, as you can see from this chart here. And then also, this is just insane right here. I can actually see this. I posted about this just recently. So if I go to my profile myself here, um, this is and also this is a thing that shows month over month rent is going down. I got this on my Twitter thing here. But this right here, what you might wonder what you're looking at here, this is me driving out of an apartment complex that has 400 units in it or 500 units in it across the street, and this is by the local hospital here. This complex goes all the way to where you see back here, and it goes all the way to the right. And then there's also a field next to it that looks like they're going to develop too, but it looks like they're about to put in maybe 400 to 500 more apartment units in here. And this is a massive apartment complex that they're building with zero pushback from the local people in the area. So this isn't like California, not in my backyard. This is whatever. There's a massive plot of land right there. Build whatever you want on it, and that contributes to this chart right here. So by the time that the Federal Reserve gets their lagged effects that they're waiting on, there's going to be a massive, massive amount of supply hitting the market. I would not get into the rental market right now if I was anybody with two brain cells. You can see what's about to happen. There is about to be a massive, just massive supply coming on in 2023. I can already see it driving around. There's places that just open that have signs that are giving out special deals for trying to attract people. And then you have the massive thing that I just showed you right there. They might try and slow that project down just to have it come on later on. But they can't have that stuff. They have to start making money on that project, so they have to list all those things. So when this amount of supply hits the market, it's going to be like a bomb hitting the rental market. I would not want to be in rentals right now, especially with this about to go down. This is about to be there's going to be a food fight. I would say between 2024 and 2025, you're going to see rents crash. Um, but that's going to be a very big thing. So that's good for renters, I guess, because they've been screwed for the last 2 years in a very, very bad way. So that's definitely something you need to watch. But that's kind of what's going on right now is the market is reacting to a little bit bad news coming in from the labor market, but this could reverse. Like if we get job openings coming down, but we also have a strong labor market, that kind of throws a wrench in like the bull thing. But we could trade sideways for much, much longer period of time as rates will go up as good news comes in, and then as you get some maybe bad news, rates will go right back down. Rates are swinging by very large percents, but right now it all depends on what the Federal Reserve says. So, like I said, that's all we're waiting on. Um, the plan is what the plan is. As you can see, target still have $90,000 to go on that target to get this one and this one to where I want them to be. Also on a SPHD, they did actually have a dividend increase recently. So this was actually 0.157 or something, and that's because Altria, one of the underlying stocks, and you can check the underlying stocks because this is an ETF. So if you go to portfolio, you can see right here. So this is the same thing you would do at SPHD, for example. So whenever Altria increases their dividend, that reflects in the overall dividend that this ETF pays. So you can kind of see what this was made up. Um, Also, the very big one that everybody also likes, SCHD. This is the very popular one. If it'll pull up, I don't know where it went, but you could do the same thing with SCHD and see what the big holdings are. I don't know why SCHD is not pulling up. Whatever. Oh, there it goes. But so, or no, that's SPHD. But you could do the same thing with SCHD. This is probably E-Trade just doing something prior to them shifting over to Morgan. Hopefully, it works with Morgan Stanley. But so that's you could do that with SHD, and then see what their biggest holding is. But that's how the dividends of the ETFs go up is when the underlying stocks have a dividend increase. But that's also how it can go down if you're holding a bunch of AT&T in there, if you're holding a bunch of Intel in there, if they were holding Disney, for example. So those are the types of ways that the dividends can go down on you. Because they don't use call options or anything like that, like like these funds here, the technology funds. They just buy a bunch of stocks and then load it up with different dividend paying stocks. So that's where we're at right now. For September, like I said, it's typically the weakest month. It's typically a reason for people to sell, and I imagine that's what you're going to see in September. It's probably a reason for people to sell. So we'll have to see where it goes. But leave any questions, obviously. Y'all have a nice day.